We're at a point of the cycle where people are concerned about equity valuations, they're concerned about duration risk as interest rates start to rise or central banks start to exit QE, and credit spreads are tight. And it seems obvious to us that investors are looking for an uncorrelated place to invest, but one that can deliver positive absolute returns. That should be the alternatives market or the hedge fund market. But over the last 5 to 10 years, hedge funds have really failed to deliver the kind of absolute returns that investors need. Our philosophy is that we think that there are a subset of that market that we can invest in that can produce consistent uncorrelated returns to equities and bonds, so act as a genuine diversifier for investors' portfolios. We think we can address the structural issues of that market by pushing fees down and investing in a cost-efficient manner. And we also take control of the strategies that we invest in, the trading strategies, in order to better calibrate the risk to achieve our goals of decorrelation and positive absolute returns. So it's about owning and controlling the risk, managing the costs, investing in a cash efficient way, and focusing only on strategies that we expect to be uncorrelated to both equities and fixed income. I think we're in quite an interesting environment as we start to see interest rates rise. And what we expect in the market is a higher degree of volatility across all asset classes. We saw that start to happen in February, particularly in the equity market. But we expect higher volatility in currencies, higher volatility in fixed income as well, and the potential for markets to move down concurrently, so that diversification effect between fixed income and equities maybe to go away. We have a number of strategies that we think can perform in those kind of environment, whether they be directly correlated to rising volatility, so those that can benefit from a pickup in vol on an outright basis, and strategies that have quite high frequency turnover and so can benefit from short-term disruptions in markets as well. And by avoiding any persistent beta to equities or fixed income, we think a more volatile, choppy trading environment should suit some of the strategies that we allocate to. Today there are 5 core strategies with risk relatively equally spread between them. We allocate to global macro, which trades primarily currencies. We allocate to trend following, which trades currencies, fixed income and equities, looking for momentum in markets, so it tends to be a strategy that can capture big down moves as well as big up moves. We invest in equity market neutral, which is a completely market neutral portfolio of around about 1,500 stocks, looking to benefit from certain behavioural biases in equity markets. We invest in short-term futures trading, which has an average turnover of about 2.5 days, and that looks to trade relationships between different liquid futures markets, both in terms of very short-term momentum and also relative value between related futures markets, using technical price indicators. And finally, we invest in statistical arbitrage, which again is a market neutral portfolio of about 1,500 stocks, looking for short-term mean reversion between pairs of stocks and baskets of stocks. And the reason that we've constructed the portfolio in that way is each of these 5 strategies has the ability to make money in a manner uncorrelated to equities and fixed income, but also in a manner uncorrelated to each other. And our ability to invest through managed accounts means we can allocate risk fairly equally to them. So in any given environment, we would expect 4 or 5 of our strategies to work, 1 or 2 of them to produce negative returns, but net the portfolio can deal with a number of different types of regimes without relying on the market. It's always been a tricky environment for ESG in hedge fund investing, but we've done what we can to try to make the portfolio as compliant as we can. It's an issue that Neuberger Berman takes very seriously. We do exclude certain stocks from the portfolio that we think would not comply with ESG criteria. Most of what we trade are liquid futures markets or large mega cap equities, and so by applying certain sector screens, we think we can at least move the hedge fund industry forward in terms of its ESG compliance.